What impact do two wars and rising long bond yields have on the equity markets? Are things really as bad as they feel right now? So I'm in a hotel room this week in Boca Raton, Florida, and it's really not a good place for doing a YouTube video. So I'm going to just use voice and charts today and talk through what's going on in the markets. And then next week when I'm back home, we'll go back to our video format where you can see my lovely face. But anyway, let's jump into the video. Let's look at how long it has been since the previous S&P 500 high water mark to get some perspective in general on how the markets react to these big downturns. What you're looking at here is a chart of the S&P 500 going back to 1927. And I'm showing you this to give you some perspective on how long recoveries can take and how deep they can be. Now, granted, the worst drawdown ever was back here in 1927 to 1932, where the S&P lost about, I think, 86% of its value. Hopefully we won't see another one of those ever again, but it could happen. More recently in 2007, 2008, and in 2000 to 2003, we had fairly big drawdowns. This one in 2007 to 2009 was about 55%. So that's a pretty bad drawdown. But what I'm also showing here is how long these drawdowns lasted. In other words, how long did it take to get back to this high water mark back here in 1927 from the bottom that we found in 1932? Well, if you look at this, it took over 24 years to recover from that previous high water mark. Now, that was the worst case one over the entire history. As you can see, in general, it's taken less than 3 years, in fact, probably more like 2 years, even at the long end, to recover, with some notable exceptions in here. Here's one that's about 7, 8 years. This one in 2003 took a little bit more than 6 years, probably 7 years. And in 2007 to 2009, it took almost 6 years to recover. Well, where are we currently? Well, if you look at where we are currently, we're just shy of 2 years here. So just based on this alone, my hope is that we've kind of seen the worst of it. And to look at this another way, let's look at this. So what I'm showing you here is the number of occurrences where from the previous high water mark to break even, it took a year or more. So I'm ignoring anything less than a year here. So there were 7 occurrences where it took 1 year to get back to the high water mark. There were 5 occurrences where it took about a year and a half. There were 4 occurrences where it took 2 years, and that's about where we are right now. And then there were 2 occurrences where it took 4 years to get back to the high water mark, and then 3 occurrences where it took 8 years. Now I'm showing you this because you can see the trend is down, even though you've got a bump here. And then, of course, there's the way back at the beginning where it took 32 years to get back, more than 32 years to get back to break even. But I'm showing you this again to give you some perspective of how long these things can take. And we're already 2 years into the drop from the previous high water mark. So hopefully things are going to turn around soon and start to head back up.
I'm afraid to say how I feel.
With all of that being said, let's take a look at how the markets look right now. So if you look back over the past week, you can see we have an unhealthy looking stock market with the highest risk equities finishing the lowest, the NASDAQ second to lowest, small caps, then S&P, and then Dow. This is an unhealthy looking risk appetite. And if we look back over the past month, you can see we had a very nice rally going here, and then it just started to falter. And where are we currently? Well, ARK and small caps are down here at the bottom. The NASDAQ still holding the top position, but it's not heading in a good direction. And then what if we take a look at year to date? Well, year to date, we're still up very nicely for most of the indices. The small caps and the Dow are not above water currently year to date, but the S&P, the NASDAQ, and ARK Innovation are all up. So this is still a fairly healthy looking rally. And how does that show up in the bottom dynamics? Okay, so if we look at the current bottom dynamics, you can see that we had an attempt at a bottom confirmation here. It didn't happen. This didn't get up high enough, and the confidence level, while it may have been high enough here, fell off. Where are we now? Well, we're heading for another bottom forming indicator. There's nothing saying that you can't have multiple bottom forming indicators in a row. In fact, we've seen that over the past several years, and I've talked about it in my videos. But that's where we're headed. And in fact, the bottom forming indicator is rising up here. The confidence level is rising, and the market's dropping. This, to me, looks like the markets could go lower before we see an end to this. How much lower? I don't know. And how do risk and opportunity look when we look at the new metrics? You can see what's happened here. The risk acceleration, this yellow line, peaked out way back here, actually before this bottom, and then it started to decline. And the risk, the red line, peaked out right about at the bottom. Now, what's happened since then? Well, the market went up, risk started declining, and in fact, now it's collapsing. Risk acceleration has really collapsed, and you can see, but the market's pulling back. Now, this blue line shows the opportunity level, and you can see that's declining as well. Now, this tends to be a lagging indicator. I'll feel better when I see this start to turn around and head back up. But right now, this looks very good with risk and risk acceleration absolutely collapsing here. So this is a little bit in conflict with what I just said when we looked at the bottom dynamics, where it looks to me like we could go a bit lower before this turns around. And what about equity versus safety? Well, if we look at equity versus safety, let's take a look at how the NASDAQ 100 has acted over the last 7 weeks. So if we take a look at the NASDAQ 100, you can see it's been quite a roller coaster. Up here in first place, dropped down to 9th, up to 7th, back to 9th, up to 4th, and now, interestingly enough, in second place, right behind gold. This is showing a healthy appetite for risk. Granted, it's risk in large cap technology, but that's okay. The Qs, the NASDAQ 100, are riskier than SPY or Dow, and they're leading the way up here. This is really good. I'm not concerned that small caps are down here. And then if we look at cash, you can see what cash has done. It was up in first place for 4 weeks in a row, and now it's fallen to third place. This is encouraging. But if we look at small caps, as I mentioned, you can see they tried to sort of come up here, but then they diverted and headed lower. Now, that doesn't give me much cause for concern. I'd like to see small caps heading up higher, but the fact that people are putting money into large cap technology is a good sign. And then if we look at the S&P 500, you can see that that has gone from 9th up to 4th place. So that's a good sign. And then if we look at the Dow, the least risky equities, you can see that there's been sort of a tail off here, which I'm fine with. I don't mind the Dow tailing off here as long as the riskier assets are moving up. The only one that's at odds with that right now are the small caps. And how does that show up in the buying and selling pressure? Well, if we take a look at the buying and selling pressure, you can see we've had a very nice attempt at a rally here in the Dow and then just a collapse. And you can see that in the buying pressure, this solid gray line, you can see the selling pressure has been coming up. If we look at the S&P 500, similar picture here. But in this case, the selling pressure has moved well above the buying pressure. And you can see a similar picture here with the NASDAQ 100, where it tried to rally, it's really dropped off, and the selling pressure has moved well above the buying pressure. ARK Innovation, similar picture, although ARK Innovation doesn't look as good as the Dow, the S&P, or the NASDAQ 100. You can see it never really rallied here, and in fact just tailed off, where each of these actually had a very nice rally going and then kind of collapsed at the end. And then if we look at small caps, which I showed you earlier, don't look that great. They never really rallied either. They sort of went flat here and then collapsed, and you can see that the selling pressure is well above the buying pressure.
I'm chasing somebody.
Now, the reason I'm showing you this headline from MarketWatch, this article published 2 days ago on Thursday, so the day before Friday, anyway. So if we read the subheadline, it says, the S&P 500 is in a clear downtrend, but defensive consumer staples sector looks solid. So what is this saying? Well, they're saying that investors are willing to put their money into consumer staples. Why? Because they're safer assets, and that the S&P is in a clear downtrend. So that doesn't look very good. Well, how does that show up when we take a look at our sector rank and sector rank acceleration analysis? Well, what I've done here is a little unusual. I've taken this week, which you're seeing right here on the bottom, and stacked it on top of the previous 3 weeks. So there's 4 weeks of sector rankings here. And let's take a look at consumer staples. So consumer staples was kind of here in the middle. It moved up here, moved up more. And then this last week, it's up here, in the top 5 or 6. So yeah, this is looking very unhealthy. You've got cash here and treasuries. So this looks like a very unhealthy risk appetite. And in fact, consumer discretionary is way down here. Well, if we take a look at that, I'm going to spread it out now. So this is a week ago, and then this is this week. So again, so you can take a look at this and pause if you want to see kind of how things have moved in the last week. But what I like here is that cash, you can see, has moved down a bit along with treasuries. Now consumer staples moved up a notch and consumer discretionary moved down a notch. So yeah, this looks a little bit unhealthy. But let's look at sector rank acceleration, because that kind of points to where things are moving. And if we look at that over the last 4 weeks, you can see what's happened with consumer staples. Yes, they were here. They moved up here. They moved into first place a week ago. So yeah, this looks really awful. And you can see that treasuries were here, but you can also see that cash slipped from here down to here. And now where are we this week? Well, and I'm going to skip to the next screen to talk about this. So where are we this week? Well, you can see what happened. Cash and treasuries have all collapsed down to here. Consumer discretionary has moved up, and consumer staples is moving down. So this is pointing to somewhat of a healthy movement toward risk appetite, but I'm a little bit encouraged by what I see here. And how do things look with the treasuries? Well, you can see that over the last 5 days, over the last week, we had a very unhealthy treasury market. The longest duration treasuries dropped the most, followed by 20-year and followed by shorter duration. So this is an unhealthy looking treasury market. Although on Friday, the longer duration treasuries did rally. It's a little hard to see here, but they did finish the day higher. And if we look back over the past month, you can see, again, an unhealthy treasury situation over the past month. And when we look at year to date, you can see we're really at a pretty severe bottom here. And in fact, if we go to a 5-year view of the markets, you can see that we're at the lowest point that we've been at in the past 5 years. So I think a lot of investors are starting to smell opportunity here. These longer duration treasuries could go up by 20, 50, 100%, if things start to go the other way and improve. But we will just have to wait and see what the Fed does, see what the world does, and see how interest rates react. Speaking of the Fed, let's take a look at the current state of the yield curve. Well, you can see here that a year ago, the yield curve was certainly starting to invert. It wasn't inverted just a year ago. Now, it was prior to that, but then it uninverted briefly. But then if you look at currently, this blue line on the top, we are inverted, but we're not as inverted as we were a month ago, this red line. And what does the market think the Fed's going to do? Well, if we look at the Fed rate monitoring tool, this is interesting. There's a 99.9% belief that the Fed will leave interest rates unchanged. But last week, there was a belief that the Fed might actually raise rates at its next meeting on November 1st. Now, there's a small chance here that the Fed will actually lower rates at their next meeting. So that's an interesting pivot in sentiment. And how does this show up over time? Well, if we look at the 10 to 2-year yield spread, you can see that we've come a long way since just last week. We're now just a little bit less than 16 basis points, 15.95 basis points inverted, whereas last week I think we were somewhere around 44, 30 something. I don't remember the exact number, but it was in the 30 to 40 basis point range. So this is really encouraging. Not too much further to go, and the yield curve will no longer be inverted. And how does all of this show up in the buying and selling pressure for treasuries? Well, you can see again that short duration treasuries have been the place to be. You can see that the buying pressure, the solid gray line, is moving higher and is above the selling pressure. If we look at intermediate treasuries, they've been in decline. And you can just look at this orange line, the selling pressure, which is above and has been above the buying pressure for most of this 2-month period. Same picture here with this 7 to 10-year treasuries with the selling pressure above the buying pressure over almost the entire 2-month period. And 20-year treasuries, very similar picture with declining prices. And what about gold? Well, if we take a look at gold with the events in the Middle East, you can see what happened here. When the events happened in Israel, the price of gold just started shooting up, and you can see that in the buying pressure, which is well above the selling pressure and moving higher. Let's take a look at Bitcoin, because Bitcoin has been a great place to be. You can see that over this 2-month period, we've had a very nice rally. In general, the buying pressure has been above the selling pressure, and you can see more recently that the buying pressure is shooting through the roof here. This is really, really good for Bitcoin. So as we all know, the market sold off again last week. But when we look under the covers, there appears to be a somewhat healthy appetite for riskier assets that's starting to bloom. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
So you wanna know my name? I hope you got a lot of time. I'm not sure what you've been told, but no one's been a friend of mine. From the day you drove the car to the riverbed, they'd never heard what I've said. So pardon me for acting wise. I know what hides behind those eyes. Where do we go when the fight comes knocking at our door? Where do we hide when they're changing all the reasons why? 91 number of disguises used to cover up the truth about the one